So Jamie Dimon, CEO of JPMorgan Chase, I feel like I've heard this headline before, right? I feel like when we were first starting the Not Your Average Market Insights, one of the first things we were going to roll with was Jamie Dimon just got big quotes, but this was like 6 months ago. But once again, made a whole bunch of waves at this like conference, like an investor conference, something or another, talking about really, really tough times being ahead and preparing for this next storm that's happening. Why is it even news right now? Didn't he already say this, GC?
Well, he has been saying this for a long time. First of all, whenever Jamie Dimon speaks, markets listen. He's the CEO of JPMorgan, right? One of the largest investment banks in the world. And the reason why it's making more news now is because this is when earnings come out for companies. And so people always pay attention to earnings because it largely affects stock prices, whether people hit expectations, didn't hit expectations. Remember, it's not about making money or not making money. It's did you do what you say you were going to do? And that's really, what affects stock prices in the short run there. So people are really looking at earnings to see how did these publicly traded companies perform. And it's an opportunity for the heads of these companies to be held accountable and also to give their thoughts on the market. And he is probably the most visible. But this is not something new. He has been talking about how the stock market and the economy are in for a rough ride. There's a couple of noteworthy things here because I went and I did a little bit more digging in here. He specifically said, listen, I know that the markets have dropped over 20% now. I think the markets could drop another 30% on top of this.
Okay.
He also got specific on the timing of this. So he came out and said, listen, in his mind, he's thinking that by midsummer of next year, by mid-year and summertime next year, he's looking at the amount of savings that people have been able to keep through the pandemic. And he's looking at that being largely tapped out based on spending levels right now. And so he expects consumer spending to dry up significantly in summer of next year. And he says that he thinks people are going to be unprepared for this. Well, he's expecting a recession, depending on whatever your definition of a recession is. Tough times economically are coming in his mind. And he has been very specific about these warnings. And also the reason behind it, I think, is cool to just conceptualize, right? Doesn't it make sense that like right now, even though it costs more for us to live because of inflation, and it costs more for us to borrow as a business or as an individual, all of these costs are rising, but we really haven't felt the economic pain of that yet. As an economy, we had more money in our savings accounts over the last 2 years than in recent history. And if you think about the effect of inflation over time, it erodes your capital. And so he's kind of put some thoughts to it and says that by mid next year, that's when the pain should really start to hit. And it's going to be severe in his mind.
Well, first of all, Chris Gonzaga saying nearly 50 trillion has already been wiped out of investors' portfolio this year, which is not in the stock market.
But think about that, because that's an incredible number, right? But does that affect your day-to-day for most people?
No, I guess not. I guess unless you are retired and living off of a stock portfolio that is supporting your lifestyle.
True. It's not good, and it does affect those. And I don't want to marginalize that because that's a real challenge, right? We've talked a lot about that on the show. But the next shoe to drop is when you just don't have the money in your savings.
Correct. That doesn't affect my spending day to day. It doesn't affect whether or not I went out to dinner tonight.
And that's really what's going to hurt our economy. I think we're just going to see an avalanche of a recession and tough economic times. And we've been talking about this for a while. And it's because when those savings really dry up, consumer spending stops, that's when job losses happen. And that's when our economy really starts to hurt.
That's what I found interesting is the idea that for me in my circles in world where I network with other marketing departments and marketing professionals, I have in the tech space, I know that tech companies have already done some layoffs, right? Like the venture capital backed company that's been like living off of an insane burn rate because money was free, they've tightened their belts, right? To me, I get a little cognitive bias, but what he said is that unemployment hasn't even hit.
Exactly.
And we've already lost 20% in the stock market. So when unemployment hits, he's seeing another 30% going down beyond the fact that inflation's already raging and interest rates are going up and all this stuff.
Yeah.
What is there to take away from that, GC? Like, what are people saying? What's the move?
I just don't think there's ever been a time that I can remember when the economic signals of pain for this economy are coming, right? Listen, we've had 2 consecutive quarters of negative GDP growth. And for most of us, that means recession. But we've never had 2 consecutive quarters of negative GDP growth with a raging job market like we've had, right?
Correct.
We're still adding hundreds of thousands of jobs. So it's this weird thing that people are like, is this a recession? Is it not a recession? If you don't want to call it a recession, this is the greatest indicator that I've ever seen of a recession coming is 2 negative quarters of GDP growth, knowing that, interest rates are what they are, and knowing what the Fed is saying about how important it is to control and rein in inflation. And so the takeaway for all of us needs to be, how am I best set up in my asset classes, knowing that economic hard times are coming? How am I best set up to survive and thrive? And you have choices. You don't have to be like everybody else who just has their money in the stock market. The normal approach for people, if they don't think that things are going to go so well in the stock market, is they put their money to bonds because that's more conservative. But that doesn't work right now. We don't have a Mark McGuire bonds market right now. We have a
bear market.
A Barry bonds market.
A Barry bonds market. Oh, man.
Barry bonds market.
I was like, a Sammy Sosa market? I don't know.
A bear market in bonds right now. And that's just because normally in a recession, the Fed actually lowers interest rates to encourage spending. This is weird, right? There's no place to hide right now if you're going in the stock market and in bonds. So if there was ever a time for you to look for another asset class that has risk mitigation built in, that has 5 profit centers named rental property investing, right? This is an opportunity for you. And, I think this is a time to be defensive with your money. And, listen, the reason that I quit my corporate job, a conservative guy like me, was not because rental properties was this huge opportunity as I was going to, make $1 million tomorrow. I loved it because of the risk mitigation aspect of it. And I felt like I could build a portfolio over years and over 10 years and over 15 years. Then I could call my own shots with my own time, right? I think all of this is really related. And I think these are strong economic indicators that this pain is coming. And go and check how the stock market works during tough economic times. And then go and see how rental properties perform. And you'll see why I think we're set up in the short run and the long run to perform well on the property side.